Hi guys, it's Marissa Schultz here, author of The Rise High Investor. Hope you're doing well. Thanks for tuning in to one of my weekly property investment videos where I help you to achieve your property investment goals. I really appreciate you tuning in and I hope you get value out of it. So today I'm talking about whether everything you spend on your investment property and your investment portfolio is tax deductible. So the answer is simply yes and no. Everything you spend on your investment property or your investment property portfolio will fall into one of three categories. They'll either be immediately deductible, which means that you can make the deduction in the year that you spend the money, or it will be depreciable, which means that the amount that you spend will be depreciated over a certain period of time, or it will be added, the money that you spend will be added to the cost base of the property. So let me just explore each one of those in more detail. Immediately deductible. So these are expenses, your everyday expenses of the investment property. So things like interest on your investment loan, your property management fees, insurance, basic repairs and maintenance where you're simply just fixing what's broken. They're the sorts of things that are immediately deductible, and in the year that you spend the money, you can also claim the deduction. Let's move on to depreciable. Okay, so this is where they're going to be depreciated over a number of years. So your borrowing expenses are actually depreciable over a number of years. So that can include things like your establishment fees, your lender's mortgage insurance, if you've paid lender's mortgage insurance to buy an investment property, your refinance costs, okay? So things like that are depreciable. You also obviously have depreciation. So if you're eligible for depreciation on the building or the fixtures and fittings, then they're also depreciable over a number of years. The other thing that gets people caught up a little bit is that if you do any capital improvements to the property, so if you improve the property, then instead of being able to claim the whole amount that you've spent in the year that you spend it, it may actually be a depreciable item. So there can be a bit of a fine line between, repairs and maintenance and capital improvements. But as a general rule of thumb, when you are needing to repair something in your property, ask yourself, well, are you actually just repairing and replacing what was there to an equivalent value? Or are you actually improving the value of the property through what you're doing? Because that might determine whether it's immediately deductible or whether it's depreciable. If in doubt and you want to get certainty before you spend the money, then speak to your accountant first so that your accountant can give you advice on what category it would fall into and what you can do to eliminate it falling into a particular category that you don't want it to fall into. So finally, we've got the cost base. So the cost base actually is important because adding money to the cost base will ultimately reduce the amount of capital gains tax you have to pay when you sell the asset. So there are things that you spend on your property that aren't depreciable, that aren't immediately deductible, but that increase your cost base, which will ultimately reduce your capital gains tax. So they're things like purchase costs, for example, your stamp duty, your conveyances fees, and it also includes improvements that you've made to the property in the first 12 months after purchase. So that's a really important thing because a lot of people buy an investment property and they want to improve it straight away, and they don't realize that those improvements, they won't be able to deduct them, and that they're going to have to wait for the benefit of that until they sell the property, if they ever sell it. So that's basically, in a nutshell, the answer to the question. Ultimately, if you hold the property and then you sell it, everything that you spend on your investment portfolio is tax deductible. If you hold it and you don't sell it, then obviously you miss out on those little things that get added to the cost base. But in a nutshell, that's basically the way it goes. So if you have any questions, comments or thoughts, please leave a comment below, or you can email me personally at propertyinvestor@risehigh.com.au. I'd love to hear from you. I love getting your messages. And as a thank you for tuning in, you are able to get a copy of the book for half price at the website, which is risehighinvestor.com.au. All you need to do is enter the code video at checkout to get your discounted copy. Thanks again for your time. I hope you enjoyed this and I will look forward to seeing you next week. Bye.